All right, so I would love to welcome to the stage. We have Meaghan Dowd. She is our Director of Product Insurance. And when I tell you, she is the leading authority on all things insurance planning, all things risk management. I have never in my life known anybody who knows more than Meaghan on this specific topic. So we are so lucky to have her here at Holistic Plan. Meaghan, over to you.
Thank you so much. Let me share my screen. Maybe.
Oh, and this is one CE credit approved. So stick around for the whole thing and you get one more CE credit.
Fabulous. Can everyone see my screen? Think we're good? Okay. So today we're going to talk through lifestyle liabilities. And as Laura mentioned, I have a background in insurance. I was in the broker space for 15 years before moving to Holistaplan. I recently wrote a book called Protect Your Lifestyle, Making Empowered, Educated, and Effective Personal Insurance Decisions, which you can buy on Amazon if you're interested in learning more about this topic after our webinar. And I'm extremely passionate about education, which is one reason I joined Holistaplan, was just to continue to help advisors learn more about risk management and the importance of it when it comes to working with clients. And when I'm not doing insurance things, I do enjoy being with family, riding horses, and reading. So it's more than just risk management, or more than just insurance, it's risk management. And when we talk about risk management, I think there's a few things that we need to kind of talk through. One is, what is insurance? And in simplicity, insurance is the transfer of risk. It's a risk management technique that removes the burden of a potential loss and shifts it to another. Typically, it's through insurance, but there's other ways to kind of transfer risk, and we'll talk through some of those. But outside of just transferring risk, when it comes to insurance, it's really important to understand that when clients have claims, especially smaller claims, they're getting a loan from the insurance company. And when I say a loan, I call it a loan because there's an interest rate of some sort. We call it a surcharge in insurance, and it's 3 to 5 year surcharge, anywhere from 8 to 15% on that first claim, and then it goes up higher. So again, when clients file claims, they're not getting free money from the insurance company. And with financial advisors, you all are in a very unique position to understand clients' financial situations. And so, again, maybe understanding when and how to use insurance is a great way to differentiate yourselves and, again, get clients to pay the right price for insurance premiums. We also have this idea of what is risk tolerance, risk appetite, and a new common thing that I've seen a lot in the insurance space, which is a flipped risk tolerance. So when we talk about risk tolerance, that's really what your clients have the ability to pallet, more specifically their potential for loss or volatility within a particular investment or situation. So for example, someone may have a high appetite or risk appetite, but still may have a low tolerance of losing large amounts of money. So when we talk about this, an example of someone that have a low risk tolerance, maybe someone that is more comfortable paying higher premiums in order to carry a lower deductible. But on the flip side, someone may be more comfortable having a higher deductible and paying more out of pocket, knowing their likelihood of a claim is pretty low. And again, just understanding clients' risk tolerance versus their risk appetite, which is really an individual's general appetite for taking on a risk, often influenced by things like financial situations, personal and life goals. An example of this would be someone that, again, is a little more comfortable investing in an aggressive stock versus a low risk stock with lower returns on that investment. So when we talk about someone that has a high risk appetite, we're talking someone that maybe is willing to self-insure a risk. An example of this for insurance would be maybe they have a home in Florida and they're not going to cover wind because the cost to buy wind is 50,000 a year, and they're just comfortable with that risk appetite. So we'll talk through this a lot more, but wanted to get some of these definitions out there to think through as we talk through this. And then last is flipped risk tolerance. And this is something where clients think they've transferred the full risk to the insurance company, such as a replacement cost of their home, when in all reality, they haven't transferred the full risk. We see this a lot where clients will insure their home for market value instead of replacement costs, and there can be $200,000 or $300,000 plus in gaps in coverage there. And again, the client has this false sense of security that nope, XYZ company's insuring my home for 500,000, we're good to go, but in all reality the cost to rebuild that home 750. So we'll talk through this more, but wanted to get these out there. And then lastly, what happens if we don't address these concerns with risk management? And this can come from, not having insurance at all or not enough insurance to cover a loss, but we see withdrawals from savings. I've seen clients have to get second jobs. I've seen clients have to sell homes or move in with in-laws. So not having the right insurance can be very damaging to somebody's lifestyle and overall situations. So, what type of lifestyle choices affect our clients and really bring on more of that risk management? We're going to talk through three case studies today to help illustrate. So, first is our renter. This is Jessica. She's 29 years old. She lives in Texas. She's a renter, has no vehicle. From a lifestyle perspective, she has a dog. She likes to host gatherings. She does travel a few times a year. She has equipment because she works from home, and she enjoys running and riding bikes around Austin. So, what does this mean from an insurance perspective? So, she does have some exposure with owning a dog, and there are liability exclusions that we see in some policies for different breeds of dogs. Labradors is not one of them, so she would be good. But if she did own a mixed breed, we may have some additional considerations. She also likes to host frequently. So, again, we have a higher risk of property being damaged, whether that's a stove fire occurring, or maybe there's candles and someone knocks them over, damaging the unit she's renting. We also have injuries that occur at parties. So maybe a guest slips and gets severely hurt. We also have the exposure of her being a cyclist, so riding around town, whether she gets hit by an uninsured driver, or maybe she's riding her bike and someone goes to open a door and damages her bike and her. Potentially, I've seen this claim arise in Chicago one time. So being a cyclist does have their own exposures. She also works from home, which is a common exclusion in the personal lines coverages. So her equipment may not be covered. Also, has higher accessibility to theft and things of that nature. And then lastly, she does travel. So when she's traveling, she has a risk of her personal belongings being stolen while she's away. And again, her unit is being vacant for that time. So potentially the increase of burglars or maybe a water leak occurring while she is gone, damaging personal property. So, from Jessica's perspective, how can she help cover some of these lifestyle risks? So, first is going to be a renter's policy. And mainly in a renter's policy, we're covering two things. One's going to be that personal property. So, she took her unit and dumped it upside down. Everything that falls out is going to be considered personal property. And for Jessica's situation, at least 25,000 in coverage. We also want to make sure she has coverage for off premise for things like her electronics while traveling. Typically, a renter's policy is going to extend 10% of the personal property coverage. So in her situation, it'd be about $2,500 while traveling. And some clients travel with more than that. So there is the ability to buy 100% of coverage off premise, but that does vary depending on the insurance company. We've also talked about liability, specifically pet liability in case the dog does injure a guest on the property. Loss of use. So if she does have guests over and they damage her unit and she can no longer live there for time being, she has some coverage to live elsewhere. And then not only protection for herself while she's riding her bike, but also making sure her bike is protected in the gear. So sometimes renters policies will provide a little bit of coverage for bicycles, but other times you will want to schedule them, especially if the bike's a higher end one or maybe an electric bike that has additional considerations around it. Since she does not own an auto, people are probably thinking, does she really need auto coverage? With her traveling frequently, it may not be a bad idea for her to purchase a non owned auto policy. This will protect her when borrowing or renting cars. It also gives her the ability to buy uninsured and underinsured motorist coverage. So, like I mentioned earlier, this would really be beneficial if she's injured by someone while riding her bike or even walking around town. If that individual has no insurance or not enough insurance, for the damages they cause. And the last statistic I saw was 1 in 7 drivers in the US has no auto insurance. So this is a very real exposure, especially for clients in cities like New York, Austin, Chicago, that even when they don't own vehicles, there still may be some auto liability to be considered. And then lastly, a personal umbrella. I do believe everyone needs an umbrella. This is not only for wealthy individuals because I would argue that people living paycheck to paycheck need umbrella coverage more than a successful individual. And that's because if you don't have the right liability, maybe again, she causes a large fire in her unit, damaging other units, and she is held responsible for some of that damage. Without this umbrella, they could garnish her wages. And if she's already living on a tight paycheck, having her wages garnished could really put her in a tougher financial situation. So, again, even somebody that's renting, having umbrella coverage is important, at least $1 million. And with Jessica's situation, she again likes to walk and ride her bike around town. So, having some additional uninsured and underinsured motorist coverage included in her umbrella could also bring her that peace of mind if she's severely injured in those courses of having fun, that there's definitely coverage there. And then just some things here that are also included in that umbrella coverage that we'll talk through in some additional examples. So next we have our growing family. This is Marcus and Elena. They have two children. Marcus is a high school teacher. Elena works remotely. They live in Colorado, two vehicles, and they do have a lab mix. So for them, their household is a little bit different with having young children. They are continually adding new furniture, electronics, and baby gear to the home. They also do travel mostly on road trips, so not as much flying. They have families, babysitters coming over, and Elena also works from home. So, what does this mean for their insurance needs? For this client, they have a few different considerations. One is young children, and there is obviously the risk of just their personal items being broke or child related damages. But the bigger and one more impactful one are these play dates and children visiting and really needing to purchase higher liability. I'll probably say this a few times in this review. Session liability is the cheapest things your clients can purchase. Going from 100,000 in liability on a homeowner's to 500,000 in coverage is like $12 a year, so about $1 a month. So again, for these young growing families, making sure they have the right liability coverage is extremely important, especially if they're the house that has all the fun play dates and brings, the neighborhood kids together. This family also has some vehicles, so they have higher mileage. So again, maybe considering full coverage or not. They do use teen drivers in a few years, so there's some considerations there, and just making sure that those younger drivers do things like driver's ed, get good grades so they can get the discounts. And then we have our home office. So again, that equipment, potential cyber. We'll talk through cyber more in this session, but really understanding when Elena's working at home, her IP address, if there's viruses on her personal network and not using a VPN while using her office computer can really provide some high risk that is not always considered when working in a home office. Again, those frequent visitors, so babysitters, grandparents. When it comes to babysitters, if it's the neighborhood individual, not a big deal. Personal liability tends to cover that. But if it's a full time individual, 30, 40 hours a week that's coming to your client's home, and they're more of a nanny, that does have some additional considerations that we'll talk through, but really making sure that if someone is there full time taking care of the children, that they're really seen as an employer at that point, and there are additional exclusions that can apply. And then lastly, just the new home improvement. So making sure their personal property does align with everything they have going on in their home. And with that, kind of what does that mean for their insurance recommendations? So for this client specifically, we're going to want to make sure they have replacement cost coverage on their dwelling. Like I mentioned earlier, with the flipped risk tolerance, the difference between replacement cost and market value when it comes to homeowners is really important. Market value is obviously what your clients buy their home for. It takes into account cost of the land, different amenities in the area. But when we're talking about insurance, we're talking about the cost to rebuild the home. So they already own the land, so we're not worried about that. But what we're worried about is the cost of debris removal to get the current structure off, and then the cost of labor, lumber, architect plans, and then obviously the work to put it together. So replacement cost is very important, especially for a growing family, to make sure that they can rebuild the home that they are in today. We also may want to talk through increasing their personal property with just all the adjustments. And then there's some additional endorsements that are not automatically included that based on their lifestyle, they may want to add, such as a home business endorsement to cover some of that equipment. We have water backup for the basement needs. So if water ever backs up into their home, water backup's what's going to pay to get the water out, plus all of those finishes. And then obviously making sure we do have pet liability. With this being a lab mix dog, there could be some issues at time of a claim depending on the breed of that mix. Not all insurance companies are strict about this, but we do see limitations for what I will say aggressive breed dogs, where maybe the client has 500,000 in liability, but then there's a sublimit of only 25,000 for animal liability, especially for, again, those aggressive breeds. So making sure you understand any caveats within the pets in home is a nice catch that you can easily call out for your clients. When it comes to auto, liability limits are important, especially since they like to road trip. Obviously, the more driving clients do, the higher likelihood they are to have a claim. And what you're looking at here is 250,000 per person with 500,000 per accident. This is typically the minimum that we see required to get an umbrella policy. Not always, some carriers have lower, but again, that's one of the reasons we recommend this limit is to qualify. But also in today's world, if a single individual goes to the hospital for a few weeks, is severely injured, 250,000 is going to add up quickly. And then the per accident limit of 500,000, if this client's in a multi-car accident, that can exhaust a lot quicker than we may think. So again, while this seems like a lot of money, one bad accident with one or two cars can really exhaust these limits quickly. We also want uninsured and underinsured motorists for the family. Maybe both mom, dad, and the children are in the car and they're involved in an accident where they're not at fault and the other party is at fault, but they only have state minimum coverage. This coverage can help apply to the family's needs for medical bills, lost wages, change in lifestyle, which for young children could be a lot, depending on how severely injured they are. We also have things like roadside, there's some discounts, and then obviously planning for the future. And when we talk about the umbrella, at least $1 million, maybe 2 million, depending on where their future income is going to come in at. And then obviously a little excess uninsured and underinsured motorist. Just some reminders of really what this umbrella is going to protect against. And then lastly, just making sure we're kind of bridging that gap across the home and auto coverages. And then lastly is our high net worth family. So these individuals have multiple homes, they have a few vehicles. Again, they do have some teen drivers in the household. So from a lifestyle perspective, we're looking at things like coastal and wildfire zones. They have employees, so they do have the nanny that works full time. They have some high value assets and they are active on social media and they're good at giving back to their community. So with all of that going on in their life, they have quite a list of exposures to think through. So one of those being that high value assets, the art, the wine, and those being damaged, whether that's due to power outages and now their wine cellar is no longer staying cool and they've just lost 200 bottles of wine, to property values and things changing when it comes to zoning. So that really comes into play with our building and ordinance coverage for these families. We then have high risk zones. So if any of you work in areas that have wildfires or hurricane exposures, you'll know that clients can sometimes have a hard time getting coverage placement. We've also now seen a rise in if clients' home portfolios are only in high exposure areas, that the insurance company may not want to write all of the homes. So this is something newer in the last 5 years, to where in the past, as long as a client had a distributed portfolio of homes, companies were usually okay with it. But now, again, if I have a client in a high wildfire zone and a high earthquake zone or more hurricane zone, insurance companies may not love to write both of those homes due to the ability of a loss occurring. So we also have that domestic staff. And when we talk about domestic staff, it's not only those injuries that may occur, but also things like wrongful termination, discrimination, sexual harassment, and insurance covers frivolous lawsuits. So your clients don't have to actually participate in any of these things, but their employers or employees may feel these ways, which is always acceptable feelings, but they'll need to defend themselves, and the insurance, homeowners insurance and umbrella will provide defense. So this is where having employment practices liability is really important for those clients that have domestic staff, so they're not stuck hiring an attorney and paying their own legal fees to potentially fight a frivolous lawsuit. And or if it actually did occur, their insurance will not only pay for the defense, but also the verdict up to policy limits. We also have luxury vehicles. The main thing with luxury vehicles is agreed value. So auto insurance typically covers cars on an actual cash value basis, which with luxury cars is not always ideal. And then we also want to talk through, OEM parts, so making sure we can replace those correctly. And potentially with teen drivers and luxury vehicles, sometimes separating out policies can make sense, but that's going to be specific to the different households. And then obviously entertaining in public. So I know Debbie said it's really fun to have clients to your home. From a risk perspective, it's really dangerous to have these client parties at your home because your business policies may not always cover them and your homeowner's liability may not cover them because it's a commercial exposure of hosting guests. So I do think entertaining, specifically when you're a business owner and there's some mix of is this personal or business, can become a little scary. And so, having some type of protection for those special events is very important. And then, lastly, cyber. We'll talk through this in a few slides, but making sure clients have a good cyber hygiene is really important. So, again, whether that's their smart home and making sure they have the right coverages, or those potential extortions, hacking. There's a lot that goes on in the digital world, and we want to make sure our clients are protected. So, when it comes to the insurance coverages for this family, we're really going to want to make sure they have that guaranteed replacement cost. So, this will mean even if the home is $2 million to rebuild according to our CoreLogic replacement cost estimator, but at time of claim it ends up being $3 million, the insurance company is going to pay that full $3 million as long as the home's insured to value. The other nice thing with high net worth carriers is they do give cash out options, which means your clients aren't stuck rebuilding at their current location. They can actually take the dwelling limit of 2 million, just go buy a home elsewhere. We'll also talk to scheduled property. So this is more of those fine arts, collectibles, making sure they actually have fire coverage and flood endorsements for those catastrophic areas in which they live. And then this home having some smart home protection and landscape is important. Then we have our auto limit. So slightly different than the growing family. For the high net worth family, we're going to recommend what's called the combined single limit. What this is doing is removing that per person cap and just giving your client $500,000 to use however necessary during that claim. So again, tends to be a little more expensive from an insurance perspective, but gives your clients more flexibility at time of claim and what's covered from a per person perspective in an accident. Also, with them having collector cars, they're going to want agreed value. Sometimes having collector cars on a separate policy with like Haggerty not only saves money, but gives broader protection. OEM parts, extremely important for your high net worth clients. This allows them, one, to take their vehicles to the dealerships to get those repairs. But two, it's also going to make sure that if their windshield is damaged and all that lovely technology in there, that they can replace it with all the technology and not just a simple piece of glass, which is the case if they don't have OEM parts. And then I'll just go through the umbrella really quickly. So based on this client's net worth, we're going to recommend 25 million. Again, with the uninsured excess motorist coverage, this family also qualifies for 1 million in uninsured liability. This is going to be if the family members have any issues off or outside of an auto accident where those other individuals don't have enough coverage. So example would be if the kids are at a friend's house swimming and they get severely injured and the friends only have $1 million in coverage, instead of having to sue the friends for the additional 500,000 in damages that the child experienced, this family actually would have $1 million on their policy to make themselves whole again, and again just allows them to move on with life a little quicker. And employment practices liability of 500,000 for those things like sexual harassment, discrimination, and wrongful termination for their employees. So outside of just the home auto and umbrella lifestyle needs, we also have things like ATVs, watercrafts, and golf carts. And the keys to these lifestyles is one, especially your golf carts and ATVs, get separate policies for them. Do not let your clients just insure them on their homeowner's policy. I have seen where, especially ATVs, people say they're used to maintain their home or their property, which does give them liability from a homeowner's perspective. However, the second that ATV is taken off premise, that homeowner's liability no longer extends. So by having these ATVs, golf carts on their own policies can make sure liability applies at any time of a loss. We also have renovation. So these are big red flags for underwriters and can void coverages if they're not discussed with insurance companies prior to the work starting, especially larger renovations where maybe your clients are moving out of the home or they're signing a contract with a contractor that may have a waiver of subrogation. So again, as advisors, your clients probably talk to you about these things ahead of time, and they may not always think to call their insurance professional. So you're in a great place. The second you hear the word renovations, make sure your clients are also reaching out to their insurance professionals to discuss what they might need to consider before moving forward with those projects. Outdoor oasis, this not only is a consideration when it comes to other structures coverage. So people have in their mind that other structures is just like your garage, but other structures is anything detached from your home. So that's hardscaping, that's pools, that's those outdoor kitchens, potentially tree houses, zip lines. And not only is there a cost to replace those things, but sometimes there's a higher liability exposure. So understanding while it may be an oasis to your clients, it could be considered a nuisance to an insurance company, and making sure that one, there's no liability exclusions. We see a lot of pool liability exclusions, a lot of trampoline exclusions. And so again, just working with your clients when you go to visit their homes, if you peek outside and you see that trampoline, just maybe quickly saying, hey, does your insurance person know that you have this trampoline? And if not, you should probably let them know. And then lastly, short term rental. This is more from a perspective of not a business activity. So, a lot of times, especially with high net worth clients, they would get a second residence in Florida or North Carolina, and they would stay in it for a few months a year, but then rent it out for the other half of the year. Before that used to be a great business decision. In today's world, when you add a short term rental exposure, it sometimes makes it ineligible for a lot of the markets out there. But two, if it is eligible, it can cost a lot, which sometimes turns it from a good business decision into a bad business decision. So, understanding if short term rental is really the right way for clients to go and having a larger conversation around that is important. And again, 5 years ago, having some sort of income being generated from a second home was not a bad idea. But now that additional income can actually trigger a lot of issues from an insurance perspective that might not always be in the client's best interest. And then when it comes to business owners, there's two big things that I like to talk about. One is titling of property and understanding the difference between personal lines and commercial lines. A lot of times this comes up one when the clients have maybe a vehicle titled in a business name because they have some tax write-offs, there's depreciation or whatever the CPA or individual had recommended there. The other time is with like rental portfolios where they have a few of their homes on a commercial policy and they'll have a personal umbrella. The personal umbrella does not extend over commercial policies, and same thing as a commercial umbrella will not extend over personal policies. So when your clients have a combination of personal and commercial policies, especially from an umbrella standpoint, it's really important that they also have a personal umbrella and a commercial umbrella, and they don't assume that they can cross cover. So that's the big thing with titling. And again, especially with cars, once especially family, we can go back to that growing family of, hey, dad has a truck that he uses for business. We put it in the business name for tax purposes, but now Johnny drives the truck. Maybe we take that out of the business name and put it back in our personal names, because if our son Johnny gets in a car accident while driving a vehicle titled to the business, not only are our personal assets out there for the taking, but now we've also potentially opened up the door for the business assets to be out there. So titling is very important, especially for business owners. And that leads me to the liability. Again, I think Debbie made mention of invite people to your homes when you're the advisor. It is a very personal touch. When I was an insurance broker, I did do a lot of events, never at my home though, because there is an exposure from liquor hosting. So maybe you serve liquor and someone gets in an auto accident leaving your house and they claim that you overserved them. We also have liability from piercing the corporate veil. Can't tell you how many times I've had clients have a rental property in the name of an LLC and we write the policy in the name of an LLC, but then they want to make the payment for that policy with their personal Amex card. Well, if we do that, we've just pierced the corporate veil. So again, as advisors, it's really important to help your clients understand and navigate all these different moving pieces. And again, liability with business owners, especially piercing that corporate veil, is something that I've seen more than once, and them just not understanding how to really keep those assets separated. I'm going to speed up because I have about 10 minutes left. I want to make sure we hit all these. So the next are just risk mitigation techniques and how we can avoid risk as much as possible. So one is the right deductible and making sure that risk tolerance aligns with what your clients actually have on their policies. With our insurance review, it is mind-boggling how many people still have $500 deductibles. That just should not be the case, especially when clients are working with financial advisors. You all probably have a savings with them, a rainy day fund, and that can be considered for deductible purposes. Less than 6% of individuals will have a homeowner's claim. So again, having the right deductible is the most important piece to paying the right price and filing claims when actually financially necessary. So we have seen some companies implement minimum deductibles. So in Texas, there's a 2% wind hail with most companies. In Florida, we've seen 1%. I think State Farm has 0.5% in a lot of areas. So sometimes your clients don't have much choice in the deductibles, but if they are willing to take more, that does always encourage lower pricing. The other piece is self-insurance. So this is a bigger conversation that I was having as I left the broker side of things, but clients are comfortable self-insuring. And again, in the past, insurance was cheaper, so it made sense to transfer a lot of that risk to the insurance companies. But in today's world, that's not the case. And not only is it not cheap, it's not always with an admitted carrier, meaning your clients can pay all this money and then at time of claim, the insurance company can become insolvent and not actually write your client a check. So those clients in Florida, again, if they have a brand new build, solid brick home, or I think solid concrete in Florida, they may not ever actually experience a wind claim. So self-insuring wind in certain situations may make sense. I had a handful of clients do that and saved $100,000, $200,000, and at 4 years by them not paying wind, they retook that money to their advisor, reinvested it. And so again, if they do have a claim, they have some money kind of earmarked for wind damage to their home, but they're not just shoveling $50,000 a year to the insurance company. So again, as advisors, you all are in a unique position to help your clients understand self-insurance and ways to better prepare for that. The other thing we've seen is multiple deductibles. So this is where, like Allstate, they have a deductible for the dwelling, a deductible for other structures, and a deductible for personal property. So while your clients may think they have $1,000 deductible, in all reality, if they have a fire at their home and it damages their home, personal property, and other structures, they have a $3,000 deductible because they have 1,000 for each of those. So understanding that insurance companies are starting to stack deductibles, and it's important to understand that is something our system actually calls out for you if we see multiple deductibles listed. And then lastly, we're seeing large loss waivers. So this is more in the high net worth space, but if a claim exceeds either 50,000 or in some cases 100,000, your clients don't actually pay their deductible. So this is where I would get creative with clients and have them go with that 25,000 or $50,000 deductible. One, knowing they could afford that if they had to write the check, but two, knowing if their claim was over that amount, they probably wouldn't have to pay that. So again, there's a little bit of a dance when it comes to deductibles, and if the client can write the check when they're, it may be waived and all these other things. So the deductible is more than just a number. And as you can see here, there's a lot of different ways you can get creative with your clients in choosing the right deductible. Next is avoiding loss with risk mitigation. So first is our typical fire, burglar alarms, having those installed, especially for second homes, having the ability to notify the fire department before the home completely burns down is very nice. Also, water shutoff valves. Water is the number one cause of loss in insurance, and water claims, if anyone has experienced them, are some of the worst. There's just so much damage that's done, and water shutoff devices stop that damage. They literally shut off the water to the home, avoiding this claim from occurring. And there's really nice discounts given when clients install these. So when it comes to claims, nobody wants to have them, and any way to avoid them is phenomenal. We've seen a new tool come out that also helps with this electrical arcing that we see in older homes with different electricity issues. So again, helping avoid fires. Also transferring risk. So one of the best piece of advice I can give with people that have pools, even if you're having an adult swim party, have a lifeguard there, have someone that's watching over that pool. So if something does happen, they can quickly execute. And it does remove some of that liability from the host themselves. And then when it comes to employees, doing background checks just to make sure that we're not hiring someone that has a background, that just opens us up to claims quicker. And then avoid. So obviously it's a lot easier said than done, but again, maybe 5 years ago, people could go buy a home and then call an insurance professional and get homebound 90% of the time, maybe 99% of the time. Today's That's just not the case. I've had probably 5 to 10 clients I can count on my hand in the last 2 years that have bought a home, bought a car, or bought a boat that I could not insure because either they were buying a watercraft that was too big and they had no prior experience. So no underwriters wanted to write the boat based on the size, speed. They were buying homes in areas that, again, had high catastrophe that insurance companies weren't willing to do. And sometimes clients called me after the fact and they already had this asset and now they couldn't get insurance on it. And that's a huge liability. So, again, sometimes talking to the insurance professionals and maybe just avoiding buying some of those issues, in my opinion, it can really alleviate some long-term headaches that you and your clients may experience. Again, don't host personal events on your premise, pay for them to be held elsewhere. And then for our clients that like to travel, while it's really fun showing off all of our nice jewelry, whatever it may be, only traveling with necessary valuables to help avoid losses is always important. So what's available? We have obviously for homeowners replacement costs, coverage, extended replacement costs. This is extremely important in areas. I used to say that we're high catastrophe. Now it's really anywhere because extended replacement costs helps take into account when there's something large that happens to an area, like a tornado that went through Joplin, Missouri a few years back. The cost of labor and lumber increases due to supply and demand in those situations. And so having extended replacement cost is really important. The other piece I want to point out here is condos. And if you are not having your clients send their bylaws to their insurance professionals, they may have completely inappropriate coverage. So when it comes to condos, they're different than homeowners in that every condo association has bylaws that specifically state what coverage a condo or a unit owner needs to carry. And that can either be walls in coverage, meaning they're covering the drywall, flooring, and all that. Or it can just be additions and alterations such as upgrades. So understanding bylaws in condos and is extremely important to making your clients whole again. We've covered most of the auto stuff and the difference between actual cash value and agreed value. And really agreed value means your client and the insurance company at time of new policy agree on the value of that vehicle. That way at time of claim, your clients can just get a quick check written and you don't have to do that negotiation back and forth between the teams. With valuables, just know there is limitations within the homeowner's policy for things like jewelry, art, and other collectibles. Typically, it's like $2,500. So if you do have clients with valuables, having a standalone valuable policy can be very helpful. And then lastly is our excess liability. Not only does it offer worldwide liability, so for clients that travel outside the US, this is extremely important as most homeowners policies and auto policies only cover liability in the US and its territories. So that's extremely beneficial when it comes to peace of mind if they do, damage a hotel room or some type of incident outside the US. There's also the ability for first dollar coverage. So if it's not excluded or covered in underlying policies, some umbrella policies can pick it up at the beginning. And there's also supplemental defense, which means your client can have some money from the insurance company to bring on their own legal counsel to help talk through a claim that has arose. Then we have our lovely digital life. So this is just shows you how much our clients' lives have changed in the last 11 years. But obviously, back in 2014, we had a few things going on. But in 2025, the chances of our clients having some type of cyber issue is very high. And so there is coverage out there. Every company is a little bit different, but we can now buy coverage for things like cyber attacks, cyber extortions. There is financial reimbursement out there. Sometimes you can get up to 250,000 for clients. It's extremely affordable, and not only does it provide a financial reimbursement, but it gives them a team of professionals to navigate cyber claims, which are extremely scary. And once you pay a hacker, they tend to continue to come back. So having a team to help clients navigate that so they don't become a target on the black market is a number one priority and something that is often overlooked. And I don't see a lot of cyber coverage come through when we're doing our reviews here at Holista Plan. So a big way to add value quickly. And the other thing this covers is cyberbullying. So again, there's a lot of keyboard warriors out there, and this can help provide defense coverage and things of that nature in those situations. Then we have our lifestyle choices. So these are coverages that are available based on the way your clients choose to live life. So they have non-for-profit directors, and officers that's just going to help provide liability in case your clients are involved in a lawsuit due to their participation on a non-for-profit board. We've talked about the employment practices liability for things like sexual harassment, discrimination, and wrongful termination. Um, we also have workers' comp. So this is what would actually pay out to the client's employees if they're injured. This also helps protect your clients from being sued. So if your clients don't have workers' comp coverage in place and they have a worker that is injured, they can be held liable for their lost income, change in lifestyle. But by having workers' compensation in place, it does one, the policy provides up to 2/3 pay for that individual. It covers their medical expenses. And again, really shields your client from that potential lawsuit, even if your client isn't at fault for those injuries or negligent for those injuries. We then have special events coverage. So if you are wanting to host people at your home, this is a great way to protect, or if your clients are wanting to host those non-for-profit events, special events coverage gives them additional liability and it gives them liquor liability up to $1 million. So definitely still allowed to have events, but just consider buying additional coverage. Animal mortality. So this is really important for those clients that have service animals, whether it's a CNI dog, whatever they may be. They're very expensive, and so clients can buy policies for those animals out there. And then lastly is our trust and LLCs. So if you talk with your clients and have them move a policy into or move their home into the name of a trust, it's extremely important that they also update their homeowner's policy. Otherwise, there may not be any coverage at time of claim. And that's because insurance is a contract. And if the trust is not a named insured, it has no legal obligation to pay out or protect it. So whether that's damage or if an individual gets hurt on the property and sues the trust would then have to hire their own counsel to help protect it, as the insurance policy would not extend. So making sure we're dotting our I's and crossing our T's when it comes to the name on the deed matching the insurance policy, again, is something that as an advisor, you're in a unique position to help guide them through. And then we have claims handling. So, real quick, when it comes to claims handling, name peril and open peril really just puts the onus on different parties. So, in a named peril situation, what this means is the insurance company is only going to cover what is listed in the policy. Typically, it's like 16 to 17 type of losses, and it's up to the insured to prove that the damage was caused by one of those 16 or 17 losses. Open peril means everything's covered unless specifically excluded, and the onus is put more on the insurance company to prove that it's an excluded coverage and not one that's not. So again, this might seem like very nerdy language, but it really makes a difference for your clients at time of a claim and how much legwork they may have to put in. And then lastly, the difference between high net worth providers and standard carriers is a standard carrier like a State Farm, a Travelers, a Safeco, they're going to read with similar kind and quality, where a Chubb, a Pure, they're going to have same kind quality. So again, depending on what your clients have in their home, that small but yet very big difference can impact their lifestyle. I had a client that had grass wallpaper in their home, and they had a loss before they got to me, and their prior insurance company wanted to put like fake grass wallpaper, and that just like was not okay with the client. So again, you all know your clients and their quality, and this is a big differentiator, and sometimes why you see a Chubb policy costing $10,000 a year and a State Farm policy costing $6,000 a year, and that is simply because of how the language reads. So, how do you implement this for your clients? One is managing their lifestyle reviews is important because clients outgrow their coverages. As we've seen, there's a lot of different things that go on in clients' lives, and insurance is not a one size fits all. So, incorporating this will just make sure that they don't outgrow their coverage and we can align them with their needs. It also protects assets under management. So, if a client does not have the right insurance and they need money, they're probably coming to you as the advisor to get that out so they can repair their home or do whatever they need. And then a differentiator. And I actually stole this next slide from Debbie because I thought it was phenomenal. But clients are expecting 72% expect insurance services. 2% of advisors are doing this right now. So this is a huge gap in the industry that you can quickly serve and help fill. And you can do that. These are lovely lifestyle questions. But how do you guys do that? And the three easy steps. So one is incorporate P&C reviews with your clients. You can do that by using this simple checklist. We also have another one here at Holista Plan that we can share with you to educate your clients on their insurance needs. Again, it's not just about replacement cost and having liability on their auto. It's also about what are they doing day in and day out that might expose them. And then lastly, work with an insurance partner or reliable technology platform to implement these personal risk strategies. So that's all. I know I went through this very quickly, probably won't have time for many questions, but I do want to say everything I covered here is covered in our review. So if you upload your client's declaration pages to the insurance review, you will get a lot of these insights. We have lifestyle engagements now that you can click on to get different recommendations based on how clients live life day to day. So please let us know what questions you have, but we are right at 4:30.
Meaghan, perfect timing, super informational, super hard hitting. Loved the real life examples. Questions were absolutely popping off the whole time. So, really, really appreciate you taking time out of your day to do a presentation for us. And it was just super educational and super informational.